Peer-to-peer, or P2P, lending has emerged as a popular alternative investment option, allowing individuals to lend money directly to borrowers without the need for traditional financial intermediaries like banks. This form of lending, which gained traction following the 2008 financial crisis, has democratized access to credit for borrowers while offering lenders the opportunity to earn attractive returns. However, as with any investment, P2P lending involves financial commitments and risks that must be carefully understood before diving in. This article aims to provide a comprehensive guide on how to get started with P2P lending, focusing on the financial commitments involved and the steps necessary to make informed decisions. What is peer-to-peer lending? Peer-to-peer lending is a method of debt financing that allows individuals to lend and borrow money without the involvement of a financial institution. P2P lending platforms, such as Lending Club, Prosper, and Funding Circle, act as intermediaries that connect borrowers with lenders. Borrowers apply for loans, which are then listed on the platform for potential lenders to fund. Lenders can choose to fund a portion of a loan, spreading their investment across multiple loans to diversify risk. P2P lending covers various types of loans, including personal loans, business loans, and even real estate loans. The platforms assess the creditworthiness of borrowers, assigning them a risk grade that helps lenders make informed decisions. Despite these assessments, the risk of borrower default remains, making diversification a key strategy for managing risk. How much do you need to invest in P2P lending? The minimum investment required to participate in P2P lending varies by platform, but it is typically low, making it accessible to many investors. For instance, Lending Club requires a minimum investment of $25 per loan, while Prosper has a similar requirement. However, to build a diversified portfolio, investors might consider starting with a larger amount, typically between $1,000 and $5,000. Diversification is crucial because it spreads the risk across multiple loans, reducing the impact of a single default on the overall portfolio. For example, an investor with $1,000 could fund 40 different loans at $25 each. If one borrower defaults, the loss is minimized compared to investing the entire amount in a single loan. This strategy helps manage risk and provides a more stable return on investment. Factors to consider before investing. Risk tolerance. Understanding your risk tolerance is essential before investing in P2P lending. P2P loans, especially those offered to borrowers with lower credit grades, carry a higher risk of default. Investors with a low risk tolerance might prefer to invest in loans to borrowers with higher credit grades, even though the returns may be lower. Loan types and risk levels. P2P platforms offer various loan types, including secured and unsecured loans. Secured loans, backed by collateral, typically carry lower risk than unsecured loans. However, the return on secured loans might be lower due to the reduced risk. Understanding the different types of loans and their associated risks is crucial for making informed investment decisions. Platform fees and costs. Each P2P platform charges fees which can affect the net return on investment. Common fees include origination fees, charged to borrowers, and service fees, charged to lenders. For instance, Lending Club charges a 1% service fee on each payment received from the borrower. These fees should be factored into the overall investment strategy as they can impact the returns. Understanding the tax implications. Interest income from P2P lending is typically taxable as ordinary income. This means that the interest earned from loans will be taxed at the investor's marginal tax rate. Additionally, if a borrower defaults and the loan is charged off, the investor may be able to deduct the loss, but this depends on specific tax regulations and the investor's overall tax situation. It's important for investors to consult with a tax advisor to understand the specific tax implications of their P2P lending investments, according to the U.S. Internal Revenue Service, 2021. How to get started. Choose the right platform. Start by researching different P2P lending platforms to find one that aligns with your investment goals and risk tolerance. Consider factors such as the types of loans offered, the minimum investment requirement, and the platform's track record. Set investment goals. Determine your investment goals, such as the desired return and the acceptable level of risk. This will guide your decisions on the types of loans to fund and the amount to invest. Diversify your portfolio. Spread your investment across multiple loans to minimize the risk of loss. The more loans you fund, the less impact a single default will have on your overall portfolio. Monitor loan performance. Regularly review the performance of your loans and adjust your investment strategy as needed. Most P2P platforms provide tools for tracking loan performance and making informed decisions about future investments. Start small and scale up. Begin with a small investment to familiarize yourself with the platform and the process of P2P lending. As you gain experience and confidence, you can gradually increase your investment. Pros and cons of P2P lending. Pros: higher returns. P2P lending often offers higher returns compared to traditional savings accounts or bonds, making it an attractive option for yield-seeking investors. Diversification. P2P lending allows investors to diversify their portfolios by adding an alternative asset class that is not directly correlated with the stock market. Accessibility. With low minimum investment requirements, P2P lending is accessible to a wide range of investors, including those with limited capital. Cons. Risk of default. The primary risk in P2P lending is the possibility of borrower default, which can lead to a loss of capital. Lower liquidity. P2P loans are generally illiquid, meaning that once an investment is made, it cannot easily be converted back into cash. Tax obligations. Interest income from P2P lending is taxable, and investors must be prepared to report this income on their tax returns. Is P2P for you? Peer-to-peer lending offers a unique opportunity for investors to earn attractive returns while diversifying their portfolios. However, it also comes with risks that must be carefully managed. By understanding the financial commitments involved, such as the minimum investment required, the importance of diversification, and the tax implications, investors can make informed decisions that align with their financial goals. While P2P lending can be a profitable investment, it requires a thorough understanding of the associated risks and costs. Investors are encouraged to start small, diversify their portfolios, and consult with financial advisors to ensure that P2P lending is a suitable addition to their overall investment strategy.